Let's talk about what are the most common misconceptions with new rental property owners. They have with tax implications on investing and investing activities because people get really confused, especially as I want to call them first time investors, like first time home buyers, but first time investors with a rental property.
Welcome to the Jennifer J. Hammond Podcast. Jennifer is a licensed realtor, educator, speaker, and best-selling author. Jennifer's goal is to help you find your yay in every day.
Hello, it's Jennifer J. Hammond. And I am so excited. One of the questions that we're all wondering about is taxes. And so as a real estate agent, but also as a real estate investor, these are things that are so on our mind. So I have an amazing guest for you today. So Mark, first of all, I'm going to say welcome to the show, but also would you share a little bit about yourself and your history, including the fact that you are a real estate investor yourself?
Absolutely, Jennifer. And I appreciate you having me on the podcast here. My name is Mark Martukovich. I'm managing partner of Business Advisory and Accounting Partners. We focus on working with small business owners and real estate investors. As Jennifer mentioned, I'm a real estate investor myself. I've owned several commercial properties and residential properties. I have an interest in a couple other developments, real estate related, and I have a lot of clients that are real estate investors. My firm has been around 31 years, and again, we focus on those people that want to be tax efficient and want to know how to use the tax code to their advantage. And unfortunately, the tax code's stacked against you by default, so it's up to us to help you out. And also, want to commend you, Jennifer, for getting an accountant to come do a podcast 2 weeks before the tax deadline, and so. Not always easy to do, but we're here and love to help real estate investors and business owners. And so I'm here to answer some questions and hopefully give you some good information about how we can help.
Well, and I'm so grateful. Thank you so much. I know we're 2 weeks. It's like that countdown clock for 2 weeks toward the tax deadline. But let's just jump in. So let's talk about what are the most common misconceptions with new rental property owners. They have with tax implications on investing and investing activities because people get really confused, especially as I want to call them first time investors, like first time home buyers, but first time investors with a rental property.
So Jennifer, a lot of people believe that rental income is tax free. It isn't. Real estate is a great tax shelter. It's a great investment, great for people that want to build wealth, but you do have to claim the income. Now, fortunately, for tax purposes, real estate shows a loss in most cases because you get to deduct a bunch of things from the cost of the property to all the money you put into putting the property in service and any expenses that you have to maintain it. But people think that it's tax free and it's not. A lot of times it does show on paper a loss. Now, the other common misconception is that you can deduct this income against your other income. So if you have a job, you have a W-2 income and regular income, we call this ordinary income. You pay tax on that. You have real estate and you might have losses from that real estate. And in most cases, you can't deduct that income against your ordinary income because there are limitations. Now, if you have other rental income that makes money and you have investment property that might lose money, yeah, you can offset those. And so you really have to know the rules of the game, and there's some limitations there. And I think it's really important to kind of get a good advisor to help you navigate through this because it gets a little tricky.
And so let's get an example really quick. So for example, if you had enough deductions, you mentioned it a little bit, but I wanted people to really emphasize this. The kind of silver lining of that is if you do have enough deductions, you could actually have a loss and pay no taxes. Correct. So it's possible.
Yeah, so that is correct. So if you earn under $100,000 in your W-2 income or your regular job, you can deduct real estate losses against that up to a limit. And then once you get over $100,000 in income, then you start to lose that benefit for real estate deduction. And people that make a lot of money, you don't have that benefit. But that doesn't mean that deduction on that real estate loss is gone. You just don't get to take it right away. You probably would be able to deduct it when you eventually sell the property. And so there's a lot of rules of the game. And again, real estate's a great investment because it's a good tax shelter and it can reduce some of your income in certain circumstances. But the beauty of it is if you have multiple properties and you have some that make money and you have others that lose, you can offset those gains from those properties.
And thank you for giving the example because it's so important to understand it and be able to know how to apply it. Again, just like as when you need a real estate agent, I'm a licensed real estate agent in Florida, DC, Maryland, Virginia, but also you need to find a professional, a tax professional. I always say you wouldn't want to go to court by yourself, right? You wouldn't want to have you're not a dentist, you wouldn't work on your own teeth. And yet people so often think that they can figure out all their tax strategies. And that always just blows my mind. Oh my goodness.
Me too. I mean, we're paid advisors. It's my job to study the tax laws and know everything I can to help you in your situation. And so it's hard to do both, be a full-time real estate investor and a full-time tax person. So that's why you hire people like us.
Exactly. So speaking of that, this is probably one of the most asked questions I get, and that is about the legal entity, the structure that's best used for owning investment properties.
All right. Yes, that is one that we get all the time, Jennifer, as well. The answer is it depends. Okay, quite honestly, but the most kind of preferred entities to use for real estate investment are land trusts and an LLC. Now, I'll give you an example of a land trust. A good time to use a land trust is when there's no debt. Okay, if there's a mortgage on the property, the bank won't let you put the property in a land trust because the land trust doesn't allow doesn't allow people to kind of attach liens to it. All right. So if there's no debt, land trust, great. It's also a great vehicle for transferring property to heirs, children or other people. So good vehicle for it. But again, it's got limitations. If you have a mortgage on that property, cannot do the land trust. If you have mortgage on a property, and in most cases, we recommend an LLC, limited liability company, is the best structure for that because it gives you a number of legal protections. And people unfortunately are student happy, and you don't want something to happen on one of your properties and have people to get access or be able to get access to all of your other assets. So people put properties in an LLC, and that gives them some protection. So then there's some discussion about, do I have a separate LLC for each property, or do I, can I group them, or can I put them all in one? That's a question that really can only be answered based on your tolerance for liability and protection. And so the discussion is not necessarily a tax question. It's more of a protection issue. And, when you start creating a number of LLCs, you could be creating a lot of extra tax filings that need to be done. So there's some expense there. So the question really needs to kind of be answered dependent upon your situation. Now, the one thing I will tell you, there's some people that put property in an S corporation. That's not in most cases what you want to do, because there are other things that come with that, and in most cases there's going to be more tax involved. You may have some benefits by putting it into an S corporation, but it's not the preferred structure. The best one, when you have mortgages, is the LLC, because it gives us most flexibility and the best protections.
Okay, that's good to know because, again, as you said, this is when I often talk about building, I call it your yay team, because I'm known for my yays, because everybody on your yay team should help you say yay every day, and specifically to their specialty. For you, for taxes. But as you just highlighted, when you talk about risk, you need to be talking to an attorney who understands what kind of risk is good, as well as, your insurance person. And I could go on with all the different people that should be on there. But definitely you need to be able to have people that can communicate and talk together as your professional, right?
I agree with you. The folks that you have as your advisors need to work in concert, and they have to be talking through the various options, because there are things that you can do from a tax standpoint that can hurt you from a liability and protection standpoint, and vice versa. So it's really important to kind of know and understand all the options and make your decisions based on all of the available information, not just in a vacuum saying, okay, I want to save on taxes, but by doing that, I could be hurting some of the other things in terms of protection or, other possibilities.
Yep, I agree. So, okay, now this is another one of those questions that I get, especially around this time of the year in April, the beginning of April. What is the most overlooked tax deduction for real estate investors?
So there are a number of them that are often overlooked, and some of those might include the technology that you spend to kind of support your activity, cell phones and computers, internet, travel and mileage, going out looking at properties, going out of town to find properties. Those are often missed. Some administrative costs that you use to kind of keep your books and keep track of things. and even home office deductions. But the one that really I think is most often understood and people probably just have the wrong idea about is depreciation. And
Mm,
so depreciation allows you to take the cost of your property and write it off over a certain amount of time. And it depends on whether it's residential or commercial property. But it's a nice little thing because that money that you're putting out to buy that property, you get to expense and take a deduction against rental income for you for your property over time. And there's some ways that you can kind of enhance that depreciation deduction, but it's most often understood and often overlooked. I'll say not in its entirety, but to the max. There are things you can do to enhance your depreciation deduction, and that's why you need people like us to kind of help you navigate through what are the possibilities and how can you get the best tax benefit for your depreciation deduction.
and that's when I say, like what you said earlier, it depends. Because every single time it
Every one of
depends
my
on,
answers is probably going to be it depends, right? It just depends, right? No, that's
well, because everybody, and I love the analogy of it's like a fingerprint. Everybody's situation is a little bit different. Just like in real estate, it's been 27 years that I've been doing real estate now, and I'll tell you that all the deals have something unique. Every single one of them is different, as unique as a fingerprint. And I would say for you, wouldn't you agree with taxes?
well, and actually, that's what I love about my job is everybody's situation is different, and there are different things that can apply to your situation that might not apply to somebody else's. So it's not a one size fits all, and that's why when you're working with a tax advisor, your focus shouldn't just be on how do I pay the least amount of taxes, because to me, tax planning is not a single year event; it's a multi-year event. And you need to think about there are things that I'm going to do today that are going to impact what I do down the road,
Right.
and so you have to look at things in a multi-year kind of possibility, and so it's really important that you have somebody that just can get that and can communicate that when you do something now, there's an impact later, and how do you get the best benefit from it.
And as you said, a lot of times that's an impact that's for many years, or I mean, it's you definitely need a multi-year strategy. So here, and speaking of a multi-year strategy, this is one that I've talked to many of my clients about, and I'm like, you have to talk to a tax accountant. So when people sell their property and they're about to get capital gains taxes, what are
Yeah.
some of the ways that investors can reduce or maybe even eliminate those capital
Yeah.
gains taxes when they sell something?
So this is an area that people often don't think about when they have a real estate property, because you get the income, you have expenses, you get your write-offs, but at the end of the day, when you sell it and you make money, guess who's your partner in the transaction? It's the IRS, right? So they're going to want
Right.
their piece of the pie, and so there are some things that you can do with proper planning to either eliminate or reduce those capital gains. And capital gain rates are favorable right now, but there's talk that they could go up and they could be less favorable in the future. So you always have to have this in mind. The ideal situation when you have rental property is to die with it and then have that pass
Yeah.
on to your heirs, right? Yeah, because when you do this, you get what they call a stepped up basis. So I'll give you an example. If I own a property and it's worth $100,000 when I buy it, and then over time it appreciates, and then down the road it's worth $500,000. If I sell that property, I sell it for 500, I own it for 100,000, I'm going to have to pay tax on $400,000 worth of profit. If you die with that property and it passes on to your heirs will then own that property at its value when you die. And so instead of them owning it at $100,000, they own it at 500,000. If they don't want to keep it, they sell it. Then they're not going to pay tax on any gain because they sell it for 500. It's on their books for 500, zero tax, zero capital gain. So that's the best strategy. And I always tell people and caution people when they're doing kind of their estate planning, if they've got a property that they don't want anymore and they want to kind of give it to the kids, don't give it to the kids. Put it in your will, put it in your trust document, and have that property pass through to them, through the trust or through the will or probate or so on and so forth. That's the best strategy. Now, other ways that you can minimize taxes, there's a thing that's called a 1031 exchange. And so what a 1031 exchange is, yeah, I love that. The 1031 exchange allows you to take one property and basically swap it out for another. So again, use the same example. I own this property for $100,000, and I it's appreciated to 500,000. Now I want to get rid of this one property that's worth this, and I want to buy something else. I can do a 1031 exchange and take that original basis, that 100,000, and move it over to the new property that I buy. And now my new property, I own it for 100,000. And so that's kind of the short way to explain it. And there's some mechanics involved with the process, but essentially you're just kind of pushing those capital gains down the road, which not a bad thing, because eventually if your strategy is to die with your property, then you'll eventually have a bunch of property that's going to be worth a lot and the kids are going to get it, right? So
Right.
there's that option. And another option that came into play a few years back is a qualified opportunity zone. And so this is
Mm,
a an investment that you can make into property into certain designated areas that when you do that, you can reduce or delay the capital gains on those properties depending on how long you hold it. So three or four different strategies right there on selling properties. Now, there's one other one that I like to tell people about as a seller of property. If you're not going to exchange it and buy more real estate, another good way to kind of defer capital gains is to do an installment sale. And so what an installment
mm.
sale is, I sell the property and then I essentially hold the mortgage on it for a period of time. And so what that does is it allows me to take whatever I made on that property and spread it out over the length of that loan period. So again, using our example, you own a property, 100,000, you sell it for 500,000, you're staring down a $400,000 gain. If I do an installment sale where I get paid out over 4 years on that property, I'm going to have $100,000 of gain each year instead of $400,000 in the year that I sell it. So it's a good way for you to kind of delay paying capital gains, maybe come up with some other ways to offset those. Again, a good tax planner can help you walk through these in your situation. And again, it depends on your situation as to which one makes the most sense for you, right? And so, a lot of opportunities there, and you really should be thinking about these as you buy your property. What's your exit strategy for this property, right? When you buy it, you're going to hold it for a period of time, but then eventually you're going to get rid of it. Is that 5 years from now? Is it 10 years from now? And then how am I going to get rid of that property and then deal with the tax implications of it?
I agree. And that's one of the most interesting things is I talk to people about that when they're first going into property is I know it sounds weird when you're just entering into the purchase of a property to be thinking about the exit, but it's really important. It's almost in a weird way, and I probably nobody likes me ever comparing this, but it's almost like a prenup.
No,
Is
I agree with you. You got to have an exit when you buy the property. There's so many so many things that go into play there, but you really make your money when you buy the property, and then
right.
when you make it, you got to think about what are the tax consequences. How do I deal with it? And lots of ways that we can help you with the planning around that.
Exactly. So let's dig in a little bit on something that I don't think a lot of people know. They probably never even heard about it. So let's talk about cost segregation study and how can that
Yes.
help me when it comes to filing taxes?
All right. So again, the answer depends, Jennifer. Depends on a lot of factors, right?
So first
But
define it so that people understand it.
Yeah. So essentially, a cost segregation study is you taking a property that you purchased and breaking that building and that structure into its component parts and allowing you to take a faster depreciation. So when you buy a residential property, you get to write it off over 27 and a half years. When you get a commercial property, you get to write off the purchase price over 39 years. That's a long time, and that yearly deduction's a small amount, right? So if you take that and
Mhm.
spread it out. But what a cost segregation study does is it allows you to look at that structure and say, okay, let's break out the roof. And the roof costs X. And the roof we can write off over a shorter period of time. What about the fixtures? What about the furniture? What about the electrical, the electrical components? All those pieces. So a cost segregation study is an engineering study that can be done by certain qualified people and allows you to take that big purchase price of the building and split it out and then get a quicker write-off on some of those pieces. It's not going to allow you to write the whole thing off over a short period of time, but maybe 40-50% of it can be split into components that can be written off quicker. And then what that allows you to do is take a bigger deduction against income. Now, again, The benefit of this depends on your other situation. Do you have other real estate income that you can offset, or is your income below the threshold where the limitations are? But in a lot of cases, cost segregation studies make a lot of sense. And generally, you can do a cost segregation study on a residential property of about a half a million or more, on a commercial property of about 750,000 or more. So it doesn't really work for kind of smaller properties, but when you get into
Mhm.
bigger properties, it really can make a lot of sense and make a big tax impact. The whole idea is by getting a bigger deduction today, you're saving against today's dollars, which are worth more than tomorrow's future dollars, right? And so the time
Unfortunately.
value of money, yeah, the inflation is always there, and the time value of money tells us that I'd rather have the money in my pocket now. So let me find a way to get that deduction now, and down the road, I'll worry about it later.
Yeah, absolutely. That's one of those ones where I cringe at the fact that inflation is just the one thing that's consistent is that you want to have the money now because you have no idea what it's going to be worth later,
That's
unfortunately.
right. Plus, you can
Oh,
take that money and deploy it into other investments now and then get it working for you, right?
yeah, absolutely. Well, and the last question I have, and that is about titling your car, your truck in an LLC or in your personal name. As licensed real estate agents, this is one of the questions I get this as well as real estate investors, but real estate agents especially are always like, "Oh, should I get it all titled in the LLC? Should I get commercial insurance on it? What's the best on this?" So, from a tax point of view, what would you say?
So I will tell you this, from a tax perspective, you can get the same benefit regardless of which way you title the vehicle. Because
Okay.
when you title it personally, you can reimburse yourself for the business use of that vehicle, whether you use the standard mileage rates or you use actual expenses. So you can get a deduction for that. If it's owned in the business, same thing. You get the deduction for the business use, and any personal use of that vehicle, you have to reimburse the company for that. So the real tax answer is it doesn't really matter because you can get the deduction either way, and there's not one way that's going to benefit more than the other. Now, I will tell you again, looking at big picture stuff, titling a vehicle in the business name is risky, okay? Because accidents happen. If you get in an accident and the vehicle is titled in your business name, your business assets are exposed. Okay. You've got some insulation if it's titled personally and you get in an accident. There still may be some issues there, but they can't automatically go after all of your business assets. So we tend to steer people away from titling a vehicle in the business name. And give you an unfortunate example. I have a client that had an employee that drove a company truck, and they were getting ready to retire and sell their business in a year. Employee got in an accident. Somebody got hurt. They were sued personally
Mm.
and in the business. And they had insurance policies that covered most, but not everything. And so what happened is they could not sell their business because they needed to keep working in it for a few more years to pay off the claims and pay off the liability. So,
Wow.
again, a lot of people will tell you put it in the business name, you get the best tax deduction. That's not always the case. The tax deduction is probably going to be the same. It's a protection issue more than anything. And for that, I would say have good insurance, title it personally, and then having a good accountant that helps you kind of figure out how you get those deductions because they're available to you.
Awesome. Well, thank you so much. Mark, I know that this has been an amazing time. But I want to make sure that everybody knows, especially as all my real estate agents and my real estate investors, this is so powerful. Thank you so much for all this. So please share with us, how can people get in touch with you if they're interested in hiring you?
Yeah. So, Jennifer, I appreciate again the opportunity. And as real estate agents and investors, you have businesses. So it's very important that you get a good tax advisor. So if people want to, meet with me or talk about, how we can help, we do offer a free consultation. You can go ahead and go to our website. If you go to appointment.bizadvisory.com, so that's appointment.busadvisory.com. That will take you to a page that will allow you to kind of watch a little video that talks about how we operate and how we do things, but then it will allow you to kind of enter some information and schedule an appointment with me. And again, we do offer a free consultation. I'd love to talk to real estate investors, real estate professionals, and help them navigate through it because it is a little bit of a niche for us. And as I said before, I love real estate. It's a great way to build wealth, and I'm an investor in real estate, so I just always love talking about it. And so happy to meet with anybody. We can meet with anybody anywhere in the country because, as you well know, Zoom makes it easy for all of us, and we can certainly do that. So, very happy to meet with you and love to talk about the options and possibilities with you.
Well, thank you so much. And that's one thing that I recommend is that you find a tax expert, whoever it might be, but make sure you find a tax expert who actually understands real estate agents, real estate investing, because there are so many that I have talked to over the years who really don't know. And, a lot of the stuff we just even discussed, they would have no clue, from cost segregation study to the most common overlooked deductions. I mean, there's just so much money you leave on the table if you don't get the right professional. So I highly recommend you hire someone like Mark. So as you know, I always like to end my podcast with a yay, because I'm looking for that silver lining. So will you say yay with me as we go off the air?
Of course I will, Jennifer.
Yay! Okay, 3, 2, 1. Yay!
Hi, I'm Jack Canfield. You may know me as the co-author of the Chicken Soup for the Soul series. And if you want more help in getting from where you are